Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we've got 5 stories for you. First up, we'll dig into why a top Wall Street analyst is chairing a public company with one mission hoarding $250 million of Sam Altman's controversial Worldcoin. Then we'll cover how Elon Musk's SpaceX just sealed a stunning $17 billion deal to buy wireless spectrum from EchoStar, a company it recently accused of spectrum squatting. After that, a quantum computing firm called Infleqtion is going public with a nearly $2 billion valuation, all on just $29 million in revenue. We'll also look at Chinese robotics firm Unitree, which is targeting a massive $7 billion IPO, fueled by backers like Alibaba, and a rare meeting between its founder and President Xi Jinping. And finally, we'll break down the brutal price war in China, where tech giants like Alibaba and Meituan burned through $4 billion in a single quarter. Let's start with a story that has Wall Street buzzing. A top analyst is going all in on Sam Altman's controversial eye-scanning crypto project. Dan Ives, one of the most watched tech analysts at Wedbush Securities, just made a surprising move. He's taking over as chairman of a tiny NASDAQ-listed company called 8Co Holdings. Their new game plan? A jaw-dropping $250 million private placement with one single goal: to buy and hoard Worldcoin. Now, what makes this so much more than just a career change is that it raises huge questions about conflicts of interest. Regulators like the SEC and FINRA have very specific rules, like FINRA Rule 2241, designed to prevent analysts from holding and promoting assets they are supposed to be covering objectively. The whole point is to protect investors from biased advice. So, when a star analyst like Ives not only invests in but chairs a company whose entire strategy is to bet on one specific controversial token, it pushes right up against those ethical lines. This isn't just a casual investment. Ives went on the record calling Worldcoin the de facto standard for authentication and identification in the future world of AI. He added, "I would not be doing this initiative if it was just a cookie-cutter token strategy." However, if you zoom out, you'll see another layer to this. While Ives is calling it the de facto standard, many privacy experts and regulators have called it a potential privacy nightmare. The core idea of scanning millions of irises and storing that biometric data is incredibly controversial. In fact, there are major competitors like Civic and Proof of Humanity developing alternative Proof of Humanity solutions that don't require you to give up sensitive biometric data, using things like social verification or government IDs instead. This is part of a much bigger high-stakes trend. It mirrors a move by another Wall Street forecaster, Tom Lee, who joined a similar company that saw its stock rocket more than 800% after he came on board. The playbook is clear. Public companies are now being used as vehicles to make massive, concentrated bets on the future of crypto. And this playbook is incredibly risky. When a company like MicroStrategy did this with Bitcoin, they were betting on the largest, most established crypto asset. Worldcoin is an altcoin, which means it's far more volatile, has much less trading volume, and faces a deeply uncertain regulatory future. For a public company to use its treasury and potentially even take on debt to speculate on an asset like this, it exposes shareholders to massive financial swings. And the rabbit hole goes deeper. This isn't just about making money on a token. It's about solving one of the biggest problems facing the AI revolution. As AI and deepfakes get more powerful, the need for proof of human is becoming critical. Ives says that without a way to verify real people, the growth of AI itself has a limiting factor. So you have to ask, is the value here driven by real technical integration with AI or by a brilliant marketing strategy that attaches a speculative asset to the AI hype cycle? Some AI coins are building real decentralized marketplaces for AI services. But with Worldcoin, the AI connection is less about its function and more about the problem it claims to solve. It creates a powerful narrative that can drive up the token's value, whether or not the tech is truly the best solution. Even BlackRock CEO Larry Fink has highlighted this exact problem, saying identity verification is the one critical issue that needs to be solved for the future of finance. Here's what makes this so wild. While a US-listed company is preparing to hoard Worldcoin tokens, the project is facing huge legal and regulatory hostility around the globe. This is a strategy of what you might call regulatory arbitrage. Worldcoin has been banned or is under investigation in countries like Spain, Germany, and Hong Kong, specifically over its biometric data collection practices. So you have a situation where a US company is betting big on an asset that is being actively shut down in other major markets for privacy violations. It all leads to a fundamental question for our future. In a world where AI and robots play a major role, how will anyone prove who is actually human and who will control the answer? Speaking of audacious multi-billion-dollar plays, Elon Musk's SpaceX just made one of its own. A $17 billion deal just dropped, and it's set to completely shake up the mobile industry. SpaceX is buying a massive chunk of wireless spectrum from EchoStar. This is where the situation takes a more complex turn. This isn't just a friendly deal. Only months ago, SpaceX was aggressively telling regulators that EchoStar was failing its obligations, letting its valuable spectrum go chronically underused. This practice, often called spectrum squatting, presents a fascinating duality. On one side, EchoStar was holding on to these incredibly valuable wireless airwaves, which are like invisible highways for data, without building out the 5G network it was supposed to. The FCC was investigating, but it seems EchoStar played the long game by holding the spectrum and then selling it to a motivated buyer like SpaceX for an immense profit. They've shown that this can be a massively profitable business strategy, raising serious questions about how our regulations are enforced. Now, in a stunning reversal, SpaceX is buying that exact same spectrum to supercharge its Starlink network. So why the sudden change of heart? The goal is a massive one. According to SpaceX President Gwynne Shotwell, it's to end mobile dead zones around the world. This deal gives Starlink the power to beam service directly to cell phones, bypassing traditional towers and carriers. The technology behind this is called direct-to-cell, and it essentially turns Starlink's low Earth orbit satellites into cell towers in space. They will broadcast standard mobile signals that your existing unmodified smartphone can connect to. But here's the catch. This won't replace your 5G city connection. Research shows that bandwidth is limited, likely around 2 to 4 megabits per second shared across a vast area. That's enough for text messages and maybe a voice call, but not high-speed data. The goal isn't to replace towers, but to supplement them where they don't exist. And if you want to know who is nervous, just look at the stock market. The moment the deal was announced, EchoStar's stock surged nearly 22%. But the giants of the industry, AT&T and T-Mobile, both dropped over 5%, and Verizon fell more than 4%. Wall Street sees the bigger picture. This deal doesn't just resolve an FCC investigation into EchoStar, it creates a brand new battleground. With this acquisition, SpaceX is no longer just relying on partners like T-Mobile. It now owns a critical piece of the puzzle itself, setting the stage for a direct challenge to the wireless establishment. On a global scale, it's all about control. By owning its own spectrum, SpaceX can decide which dead zones in which countries get service. We saw the geopolitical implications of this during the conflict in Ukraine, where access to Starlink became a critical strategic tool. This move gives a single private company unprecedented power to influence global communications. This $17 billion move suggests the war for the future of connectivity has officially begun, leaving us to wonder, is your cell phone carrier about to be disrupted by satellites? We were just talking about the battle for next-generation connectivity. Now, let's shift our focus to an even deeper frontier, the race for quantum computing. A quantum computing firm named Infleqtion just announced it's going public, and the number that's catching everyone's attention is its valuation, nearly $2 billion. Especially when you consider its revenue over the last 12 months was about $29 million. So how does that math work? Well, it's a calculated bet on Infleqtion's unique technology. They use a method called neutral atom quantum computing. Essentially, they use lasers to trap and control individual atoms, using them as qubits, the basic building blocks of a quantum computer. They've already built a 1,600 qubit array, which is the largest of its kind to date, and they've shown incredibly high accuracy, or what scientists call fidelity, in their operations. Investors are betting that this specific approach is the one that will scale up and win the quantum race. And what really brought this to a head was the decision to go public via a SPAC, a blank check company led by veteran Wall Street dealmaker Michael Klein. For a deep tech company like Infleqtion, which needs huge amounts of cash for research but isn't profitable yet, this is a game changer. The process can take just 3 to 6 months, while a normal IPO can take over a year. It allows them to get valued on their future promise, not just their past sales. This isn't just paper money either. The merger is expected to pump over $540 million in cash into Infleqtion, all to accelerate its work in some of the most critical fields on the planet: artificial intelligence, national security, and space. And if you think this is a one-off, you're wrong. The quantum computing gold rush is officially on. Competitors like IonQ and D-Wave Quantum have already used similar SPAC deals to hit the public market. This is a high-stakes race to build the next generation of computing, and Wall Street is placing its bets. The client list proves the stakes are real. Infleqtion systems are already being used by chip designer NVIDIA, the US Department of Defense, and even NASA. And the applications here are frankly mind-blowing. When you hear Department of Defense, don't just think of computers, think about quantum sensing. We're talking about next-generation atomic clocks for incredibly precise timing, and quantum inertial sensors that could allow submarines and aircraft to navigate perfectly, even if GPS is jammed or spoofed. The military is already field testing these kinds of sensors to detect stealthy threats by measuring tiny magnetic or gravitational changes. This technology is moving from theory to reality, and with a customer like NVIDIA, it points to a future where AI helps design and control quantum systems, and in return, quantum computers could one day supercharge AI model training. So are we witnessing the start of a quantum revolution or the next great tech bubble? It could be a bit of both. A key point to understand is that much of Infleqtion's near-term business is likely driven by those more practical quantum sensors we just talked about. The massive valuation, however, is a bet on the much more speculative long-term prize, a full-blown, world-changing quantum computer. Speaking of the global tech race, another major player is making a huge move, this time in China. A Chinese robotics company, Unitree Robotics, is aiming for a staggering $7 billion IPO. A valuation this high isn't just about impressive technology. It's also a clear signal of its status as a state-endorsed national champion. This IPO is planned for Shanghai's Star Market, an exchange known for giving tech companies very high valuations, partly because it's a key part of China's strategy to build up its own tech giants. Believe it or not, the company is targeting a 50 billion yuan IPO. That's a massive leap from its valuation of just 12 billion yuan only a few months ago in July. The company is already profitable, with annual revenue surpassing 1 billion yuan. Interestingly enough, that revenue currently comes from sales to niche markets, like universities for research and companies using them for events. The real challenge, and their next big move, is transitioning from this specialized market to mass market industrial or even consumer applications. To do that, they've introduced a humanoid robot, the G1, priced around $16,000, which is a huge step toward making these machines more accessible. So what's fueling this explosion? It turns out some of the biggest names in tech are placing their bets. Giants like Alibaba, Tencent, and automaker Geely have all invested in Unitree, a company known for its viral videos of human-like robots that can walk, climb, and carry loads. When we place Unitree's strategy alongside that of a company like Boston Dynamics, the difference becomes clear. While we all know Boston Dynamics with its highly advanced proprietary systems, Unitree is playing a different game. They are combining affordable hardware with open source software. This means they are making their control algorithms and learning frameworks available to a wider community of developers, hoping to accelerate innovation from the outside in. It's a bold move to democratize robotics development. But the story goes deeper, and right to the top, Unitree's founder, Wang Xingxing, was one of a handful of executives who attended a rare meeting with President Xi Jinping earlier this year in what was seen as a major signal for China's tech sector. And this is where the story takes a very serious turn. This state-level interest highlights what's known as the dual-use dilemma. While Unitree states it focuses on civilian applications, its technology can be adapted for other purposes. In fact, just this year, Chinese state television showed footage of the People's Liberation Army using a Unitree robot dog that had been equipped with an assault rifle during military exercises. This is a stark reminder of how advanced civilian tech can be integrated for military use. This isn't just about one company. It's a key move in the growing technology competition with the United States. Beijing is investing billions in robotics, semiconductors, and AI, and this IPO is a major test case for its push toward technology self-sufficiency. After all, achieving full self-sufficiency is incredibly difficult, even for a company like Unitree. While they are developing many core components in-house, they still rely on foreign suppliers for some of the most critical parts, like high-performance actuators, the motors that allow for precise, powerful movement, and specialized sensors. This creates a potential vulnerability to international trade restrictions. To put this valuation into perspective, total proceeds from all onshore China IPOs so far this year have been about $7 billion. If successful, Unitree's IPO would be one of the biggest onshore tech listings in years, potentially reviving a market that's been quiet for nearly 2 years. The question now is, with a valuation this high and backing this powerful, is this the moment China's robotics industry officially steps onto the world stage to challenge its rivals? From China's ambitions on the world stage, we now turn to a brutal battle happening right on its home turf. Imagine China's biggest tech giants burning through over $4 billion in a single quarter. And that's just the beginning. Alibaba, JD.com, and Meituan are locked in a bitter price war for control of the booming one-hour delivery market. This isn't just about getting your groceries faster. It's about a new frontier called instant retail, where companies promise to deliver almost anything to your door in 30 to 60 minutes. To make that happen, they're not just cutting prices, they're building a massive high-tech logistical nervous system. We're talking about a logistical arms race. For example, Meituan has already set up over 30,000 hyperlocal flash warehouses close to customers. They're using AI-powered routing to shave seconds off every delivery, and are even experimenting with delivery drones, which have already completed nearly 300,000 deliveries. This infrastructure is the real long-term prize. They're flooding consumers with discounts and coupons, and one analyst is calling it a high-stakes game of chicken. But that's not the whole picture. While consumers get cheap goods, this price war is putting immense pressure on the gig economy workers who make it all happen. The reality is, the platforms are often subsidizing these discounts by squeezing the delivery riders. Research shows that despite some new social security benefits, the intense competition has driven down per delivery earnings. In one case, riders from Meituan were paid an average of less than 52 cents per order. This forces them to work longer and faster just to make ends meet. The fight is so intense, the chief executive officers of these rival companies are all going on the record. One warned of unsustainable excessive competition, while another flagged a new phase of competition that has intensified further. This isn't just corporate drama. It's so significant, it's actually shaping the country's economy. This price war is actively contributing to deflationary pressure in China. By constantly driving prices lower and lower, these tech giants are creating a cycle that can lead to lower wages and reduced consumer spending across the board. In fact, China's Producer Price Index recently saw its deepest drop in years, and this tech sector war is a key part of that story. To win this war, they're preparing to spend a staggering 160 billion yuan, or more than 22 billion US dollars, over the next 18 months. The damage is already showing. JD.com's push into food delivery nearly wiped out its entire second quarter profit. And it's not just JD. For instance, Meituan saw its net income plummet by 97% in a single quarter because of this fight. Even PDD Holdings, a company famous for its low prices, is now admitting its own profit levels are not sustainable. So why are they doing this? The prize is massive. For a company like Alibaba, winning the instant retail segment could add 1 trillion yuan in sales over the next 3 years. They are all betting that this short-term pain is worth the long-term gain. The strategic endgame isn't just to sell cheap stuff, it's to acquire users and convert them into loyal customers on their core higher margin platforms. In business terms, they are spending billions on customer acquisition costs, or CAC, hoping to achieve a high customer lifetime value, or CLV. The big question is whether these discount-hungry users will ever become loyal enough to make that math work. Here's where it gets really interesting, because it creates a regulatory paradox. The government publicly warns against this race to the bottom, but the companies just keep burning billions. Why? Some analysts believe this might be a tacit or unspoken allowance. The government might be publicly scolding the companies while privately letting the war continue, knowing it will force the market to consolidate around a few strong players, which could be easier to manage in the long run. This leaves a critical question hanging in the air. In a battle this big, with billions already on the table, who will yield first? The company with the deepest pockets or the government itself?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.